In 2008, the global financial system nearly collapsed, not because banks ran out of money, but because a part of the financial system most people had never heard of froze. It had no official name, no clear regulator, no safety net, and yet, when it stopped breathing, the regular banks stopped breathing too. And here's what almost nobody tells you: that system never disappeared. It got bigger. Let's start simple. Think about a supply chain. You want sneakers. A factory in Vietnam makes them. A shipping company moves them. A distributor stores them. A retailer sells them. You buy them. Simple. Each link does one job. The chain works only if every link holds. Now forget the sneakers. Replace them with money, because that is shadow banking. It's a supply chain, but instead of moving shoes, it moves money and risk from one pocket to another, across dozens of institutions, legal structures, and balance sheets you've never seen. That's the definition. Simple and unsettling once you pull the thread. So why does this system exist? Traditional banks are boring on purpose. They take deposits, they make loans, they hold capital as protection. Regulators limit their risk. That limits profits, but it also limits disasters. Shadow banks: no deposit insurance, no central bank safety net, no strict leverage rules, which means they can offer higher returns, move faster, take more risk. That's always the pitch. Higher yield, smarter structure, more efficiency. And now the supply chain begins. Imagine a loan factory. Call it originator company. It creates loans, mortgages, corporate loans, whatever, but it doesn't want to hold those loans for 30 years. Too slow, too capital intensive, so it sells them to something called a special purpose vehicle, an SPV. Think of it as a warehouse. Loans go in, bonds come out. Those bonds are sold to investors, pension funds, money market funds, insurance companies, hedge funds. They want yield. The bonds offer yield. Done. Except not really, because many of those investors borrowed money to buy those bonds. They go to something called the repo market, a short-term lending market. They pledge the bonds as collateral and borrow cash overnight, and then they roll that loan every single day. So now you have a loan that became a bond that was bought with borrowed money that gets re-borrowed every night to survive. That's not exaggeration. That was reality. And at every step, someone earned a fee, someone rated the risk, someone insured it, someone took a spread. It looked profitable, it looked diversified, it looked safe, until it wasn't. Before 2008, the shadow banking system in the United States was bigger than the regular banking system, roughly $20 trillion. US GDP at the time, about $14 trillion. Let that sink in. A financial system larger than the economy itself, operating outside the safety net, deeply connected to insured banks. The vulnerability wasn't just complexity, it was something called maturity transformation. Borrow short, lend long, funding 30-year mortgages with overnight money. Every night, the loans had to be rolled over. Every night, confidence had to hold. The moment lenders hesitated, liquidity vanished. Not necessarily insolvency. Liquidity. They had assets, but they couldn't turn them into cash fast enough. That's a bank run. Except it didn't happen in branches. It happened in repo markets and commercial paper markets most people had never heard of. And when Lehman Brothers failed in September 2008, the run accelerated instantly. Here's the irony. The shadow system grew partly because of regulation. In the 1970s and 80s, banks faced limits on what they could pay depositors, so money flowed into money market funds instead. Not technically banks. Banks adapted. They turned to securitization, to capital markets, to short-term funding. The shadow system was the industry's response to the rules. Then it grew so large that when it cracked, governments had to bend the rules to save the system anyway. Regulation built it. Deregulation fed it. Emergency intervention rescued it. The cycle continues. After 2008, traditional banks were tightened up. More capital, more stress tests, stricter leverage rules, and predictably, more activity shifted into the shadows. Private credit exploded. Non-bank lenders now make trillions in loans. Limited disclosure, limited liquidity, no deposit insurance. Asset managers, not banks, now control enormous pools of credit. Globally, the non-bank financial sector is over $200 trillion. Global GDP, about $100 trillion. The shadow system isn't small anymore. It may be the main system. This isn't necessarily a crisis tomorrow, but it is a system where risk moves in ways that are hard to trace. The loan on your building might be part of a CLO owned by a pension fund that funded itself overnight using collateral that's been pledged twice. When it works, works. It's financial engineering at its finest. When it breaks, nobody knows who owes whom. Nobody knows where losses sit. Nobody knows which link fails first. The risk has been sliced, tranched, distributed, until it disappears, until it doesn't. So here's the real question. We built a system designed to move risk away from places where people could see it, and we called that innovation. Maybe it is. It funds companies, infrastructure, growth, but it also distributes accountability until no one is responsible, until a crisis hits, and suddenly everyone needs a bailout, and nobody was technically in charge. The sneakers got made. The supply chain worked perfectly until every factory, every shipper, every warehouse turned out to be connected to the same borrowed money. And that invisible company, it still has no name, no address, and no number you can call.